So when looking at chapter 18, we're obviously creating an account based on what we expect is going to happen or based on what has happened. Right, so we need to identify what these things are. Yeah, so provision for doubtful debts. Okay, those are the two concepts that we need to cover in this chapter. It's short, it's only 6 pages. Okay, this one. These are nice short little sections that obviously get used in a bigger question later. Okay, so to start off, let's define what they are. Okay, do you know what bad debt is?
You don't get it.
From who?
From debtors.
Very good. Okay, there's the key. There's a definition. Right, so bullet number 1. Okay, bullet number 1. Bad debts arise when debtors don't pay. Okay, now we know what it is in terms of definition. Do we know what element it belongs to? The bad debt. What do you think bad debt is?
Bad debts arise when debtors don't pay.
Correct. But what do you think the element is?
It's expense.
Good. Okay, so there's the next bit. Right, bad debt equals expense. Bad debt equals expense. Okay, so if you know that bad debt's an expense, expenses get recorded where? Statement of profit and loss. Okay, statement of profit and loss. So that's important because I see here they talk about the statements. Alright, so just make a note, next bit. So yeah, bad debt is an expense, and you can say expenses are recorded in the statement of profit and loss. Okay, recorded in the statement of profit and loss and other comprehensive income. That's just a long name, or income statement even. Okay. Right, so now we know where to put it. Okay, that's the first part. Second part is what is the provision for doubtful debts. So that's the next bit. Let's define it. Okay, so you've looked at bad debts, now we need to look at the provision. Okay, so separate bullets, maybe use a different type of bullet, maybe like a star, because these are different ones, or a line, or a, yeah. Okay, so provision for doubtful debts.
Yeah.
What do you think it is? Well, explain it in terms of a concept. Like if someone doesn't know what a provision for doubtful debts is, what would you say it is?
Provision for doubtful debts is just providing for future losses.
There, that's the key. Okay, it's being prudent. Alright, so provision for doubtful debts is following the concept of prudence in order to, and we will explain what you just said. Following the concept of prudence in order to provide for future debt. Okay, what you said is perfect. Okay, we can use that. Alright, so if you look at the textbook, you'll see they describe irrecoverable bad debts, okay, which is what we just spoke about. They spoke about businesses selling to a debtor. Okay, so when debtors don't pay, then we know that's a bad debt. Okay, then you write it off and it goes where? Statement of profit and loss. But if you think that debtors aren't going to pay, then what are you going to do? Create a provision. See, those are two different things. Okay, so now, what do you think a provision is? What type of account?
It's a
good. Okay, so next bullet, negative assets. And then where would you show a negative asset? Well, yes, but statement of financial position or statement of profit and loss. It's a negative asset. So where do you show assets?
The other one.
Financial position. Okay, so line. This is a little bit of a longer description because we're looking at what it does. So you would say record the provision against the debtor's balance. Okay, because you're going to take the debtor's balance and you're going to subtract the provision from the debtor's. Right, against the debtor's account or the debtor's control account if you want to use the total. Okay, you do have to use the total. Yeah. Okay. Debtor's control accounts in the statement of financial position. And that's where you would disclose it. Okay, that's where you show it. Right, so that's all the theory. Now we need to look at the accounting. Okay, so now you can put a heading here, accounting for transactions. Okay,
That's
so
not in the new page, or
you can if you want to, that's fine. Yeah, big heading, accounting for transactions, and it will label them. So number one is the actual bad debt. So how do you capture bad debt in the books of the business? Let's look at the debits and credits. Okay, so accounting for transactions, number one, recording bad debts. 2 dots, and then let's write the debit and credits. Accounting for transactions. Number one, recording bad debts.
number one.
Recording bad debts. That's the heading. Okay, then underneath that, let's show what we would do to record it. Right, so you tell me. We've looked at it before actually, so it's a bit of revision, but let's see if you can get it. Or would I debit or would I credit?
Debit bad debts, credit bank.
Debit bad debts, credit bank? No. Debit bad debts, yes. Not credit bank. There's no movement of cash.
Okay.
Try again.
Credit debtors control.
Credit debtors control, yes. Because you're writing off bad debt, perfect. Okay, debit bad debts. Next to that, put a bracket, expense increase. Debit bad debt, expense increase. Okay, why? We're writing off bad debt. Credit, what did you just say? Debts control, good. Or trade receivables. Rather use trade receivables because that's what they use in the textbook. Trade receivables. Bracket, asset, decrease. Right, does that make sense? Okay, so that's the transaction that you would record when writing off bad debt. You reduce your asset because they're not going to pay you. Okay, and you record the expense because you've actually created a loss. All right, does that make sense? Okay, where did we say that's going to be posted? We saw it earlier. Statement of?
Income statement.
Income statement. See, there's it there. Okay, so I'm just going to use the textbook as an example. Okay, so here on this page, they show you bad debt. Debit bad debt, credit, Musa. Okay, Musa is obviously the debtor. Okay, after we've done that, where do we show the actual bad debt? In the income statement. Right, so do you agree you're going to debit bad debt? Bad debt is going to have a debit for all the different debtors. Okay, what do you do with the income statement? You transfer the total. Okay, so what's the total here? Well, is Musa the only debt that didn't pay? No, Musa and Tina didn't pay. So this amount and that amount gives you 235. Okay, what do you do with this 235? You close it off to the expenses. Okay, you show bad debt as an expense in the statement of profit and loss, yeah, and that's what you do. Okay, is that alright?
Yep.
Okay, next one, number 2. Creating a provision for doubtful debt. That's the next topic here.
Creating a provision.
Yeah, creating a provision for doubtful debts. Okay, a little bit of theory here, just to discuss it, and then we can look at the actual accounting. What do we debit, what do we credit? Okay, so theory, I don't know how you want to show theory, maybe a bullet or something. Okay, so bullets. The provision is calculated as a percentage of the outstanding debtors. The provision is calculated. The provision is calculated as a percentage of. As a provision of.
As a percentage of?
Yeah, as a percentage of the debtors' balances. Debtors' balances. Perfect. Okay, so just to put this in perspective. Okay, so let me relate it to your business. Okay, so you're providing ladies with a service in terms of nails and beauty and things like that. Okay, so let's assume that you are providing certain customers with credits. Okay, so what are they to your business? A debtor or creditor? Good. Okay, so you have a certain amount of debtors that are your customers. Sorry, it's just, okay, so if I've got those customers that are owing me for services that you've rendered or that you're going to render, depending. Okay, let's say you've operated the business for a month. Are you going to know how many debtors are going to not pay you in that first month that you operate? No, you won't. In the second month, will you know how many of last month's debtors haven't paid you? Probably. You'll have a better idea. Does that make sense? And then what happens in the third month? Will you have a better idea of how many people haven't paid you in the first month? Mm-hmm. Yes. Because do you agree, if you sell something to someone today, if they don't pay you next month, you'll follow up.
Yeah.
But you're not going to write off the bad debts.
Yeah.
Second month, you'll follow up again. You're not going to write off the bad debts. Okay, if you go back and back and back and they still don't pay, they still don't pay, they still don't pay, after maybe 3, 4, or 5 or 6 months, you're going to write them off and say, I'm never going to receive this. I keep calling these people to pay for their products and they don't. Okay, so what are you going to do? Write it off, exactly. Okay, so have a look at this example. It's just showing that concept. Okay, what we discussed is what's in here. Okay, so have a look at the time outstanding. Are you going to write off bad debt in the first month? No, because the likelihood of them not paying you isn't very high because it's only month number 1. Okay, but now what happens when I go later on?
Increases.
Exactly. The provision for doubtful debt increases because now, can you imagine selling something in month 1 and now it's a year later and they still haven't paid you? Okay, the chances of them actually paying you are very slim. Okay, they've used 50% in this example. It's just an example. Okay, practically every business is different. Okay, so you might have very good customers that always pay you. Then your provision might be 1% all the time because all your customers are good. Okay, maybe you have another business that has bad customers and their provision might be 10% because it's just the type of customers they have. Okay, does that concept make sense? Okay, so that's what you're doing here. None of that you would have to do because that's too advanced. What they would have to do for you is they would have to give you questions where those questions actually have a percent that you're writing off. Okay, it would be impossible for you to guess, do I write off 5%, 10%, 20%, 30%? They'll never do that. Okay, so all we need to write down here is the percentage is based on the debtors that we already have. Okay, so just put a note there. The provision must be calculated on the past debtors. Okay, so you're not looking at the future. The provision relates to the future, but it comes from the past. So that makes sense. It's after you've sold them something. Does that make sense?
Yeah.
Okay, good. Okay, so here's an example. Let's do one EG and then we'll do the accounting for it. So EG, at 31st October 2014, debtors control equals 31,900. I'm using the same numbers here just so we don't have to do any calculations.
Debtors control
equals 31,900. Okay, perfect. Right, next bit of information. The provision is at a rate of 2%. Provision at a rate of 2%. Right, and remember the 2% could have been 5%, it could have been 10%, it just depends. Okay, they must give you a percentage. Okay, so what is the provision going to be? 2% of 31,900, do you agree?
Yeah.
Okay, so just put a note, this would be the answer, so the actual accounting. You can put an asterisk next to this. The provision for doubtful debt amount is...
So is this the next bullet?
This is the answer. It's like this. We're going to debit and credit, okay? But we need the amount first. Okay, so asterisk, calculate the provision, and then you can say equals, and we can just put the amount in. Calculate provision equals. You can show the working even. Just say 31,900 times 2% equals. Perfect, like that, yeah. Times 2%. Next line, you can just give the answer. The answer is 638. There's the answer. Okay, 638. Right, so now how are we going to record that provision?
Okay.
What do we debit, what do we credit? Debit what, credit what? What do you think? You tell me and then we'll check.
Debit, credit provision for that.
Definitely. Okay, a negative asset must be credited, so that's the easy bit. Credit provision for doubtful debts, 638. Credit what? Debit what? We've got the credits.
And then debit, bad debts.
Debit bad debts, 100%. Good. Okay, so see what do you actually do? You actually provide for bad debts today that relates to the future. Next to these, write down the reason. So next to bad debt, open brackets, just write E increase, E arrow up even. Okay, expense increase, and there will be NA, negative assets increase. Okay, good. Then just underneath this, where would you disclose this? No, statement of financial position. So actually, you're not wrong. Where would the bad debt go? Profit and loss. And the provision? Financial position. There we go. Okay, so I don't know how you want to write that down. Maybe abbreviate SOFP or something like that. Or you can write it out. Statement of financial position will show the provision. Against what? We wrote it down earlier. You take it off where? Your bad debts. Your debtors, sorry. Okay, because it's statement of financial position. So actually, while you've got that, underneath this, open a bracket. Show what is the total? 31,900 minus 638. Okay, that's what you would show in the statement of financial position. Does that make sense? Okay, and the bad debt you will show in there. So maybe write an arrow at the top there and just say that'll be the expense. You're not going to add or subtract or anything. You're just going to show it as an expense. Expense in statement of, or income statement even. Perfect. Short, right. Okay, and that's that. What else do we have here? Okay, we've looked at the recording of the provision. We've done that. Okay, last bit, decreasing, increasing provisions, and then bad debts recovered. That's the last bit that we have. Okay, chapter 18 complete. Okay, so on the last page, 2 scenarios. Okay, so there's 3 things that we need to still do. The one is increasing a provision, the one is decreasing a provision, and then the last thing is the recovery of bad debts. Okay, so I think maybe as a heading you can just say other considerations. Right, so number 1, it still relates to bad debt, but these are other. Okay, so other considerations. Number 1, increasing a provision. Okay, so if I've got a provision, I've created one. Now I need to check if that provision is still relevant this year. Okay, so every year you would do the calculation. Next year, I see how much bad debt I've got, and I work out 2% on it. Okay, 2% on that amount is either going to be more or less. So in that example that we just looked at, that was 2% on 31,000, do you agree? Let's say if it was double. Okay, then will my provision go up or down? Exactly. Okay, so when do you increase a provision?
When more debts occur.
When a bigger future amount needs to be provided for, yeah. So you can put a bullet here. If the percentage increases, or if the debtors increase. Right, so we can have the same amount of debtors, but next year we provide for 5% instead of 2%. Then it'll go up. Okay, or we can have 2%, but now our debtors have gone up to 100 instead of 31. Does that make sense? Okay. Right, how do you account for the increase in the provision? That's what you need to write down. What do I debit, what do I credit? What do you think will debit and credit? Try. How do you increase a provision?
Credit the provision.
Here we go. Okay, good. Right, so it's quite basic if you know what the accounts are.
Was it just a provision?
Provision for doubtful debt, yeah. That's what they use in the textbook. Provision for doubtful debt, you can put NA increase. And what would you debit? Good, same as before. Right, so whether you're creating a provision or increasing the provision, the transaction is actually the same. Expense increase. Okay, perfect. That's the first one. All right, number 2, decreasing a provision. Okay, so when can that occur? That'll occur if the percentage decreases or if the debtors decrease. Those are the 2 scenarios. So you can do the same as what you did at the top. If percentage decreases or debtors decrease. What will be debit, what will be credit? How do you decrease a provision? By debiting, yeah, the complete opposite, good. Okay, so provision for doubtful debts, in brackets, negative asset decrease. Right, and credit what? Bad debt, yeah, you would reduce the expense, okay, because you're providing for less of a bad debt. Okay, perfect. Right, and then your last point is number 3, recovery of bad debts. Okay, so here's the example. Let's say you've got Lady A that comes to the business and asks for her nails to be done. Okay, Lady A is a debtor for your business. Lady A cannot pay in month 1. She cannot pay in month 2. She cannot pay in month 3, in month 4, and in month 5, and in month 6. Are you going to write her off? Yes. What happens at the end of the year? Lady A comes back to your business and says, sorry for not having paid you 6 months ago. Okay, she was going through a difficult time. Maybe she lost her job or something happened in the family and she couldn't pay her expenses. Right, but she's still a good person, and 6 months later she comes to you and says, sorry Brittany, I need to now pay you because I did owe you previously. I'm now able to pay you, and she chooses to. Is she still your debtor? No, she isn't. So can you create a debit bank credit debtors? No, you can't, because there is no debtor. Do you agree? Right, so what do you think you're going to do for a recovery of bad debts? You would show it separately. Okay, so just a note, a bullet. This is a completely separate transaction that arises later after having written off bad debts. Okay, so we don't relate bad debt to or debtors to this. It's completely standalone. Okay, this is a separate transaction without affecting debtors. Yeah, it doesn't affect debtors without affecting debtors. Recorded separately. Okay, so what do you think we're going to record? Debit what, credit what? If someone is coming back to you 6 months later and they acknowledge that they owed you 6 months ago, and because they're a good person and they want to actually like mend the relationship, maybe.
So, debit provision.
No, there's no provision, no debtors, no nothing. Remember, it's completely separate.
I don't know.
Okay, so what are you getting from her?
Money.
Good.
Debit bank.
There we go. Debit bank, because they would have paid you, asset increase. And what would you record as a credit? Income. Okay, but what income? Give it a name. Bad debts recovered. Okay, bad debts. Bad debts recovered. It's its own separate account. Okay, bad debts recovered is an income. So brackets income increase. Okay, so you don't reinstate her debtors and then show a receipt.
Yeah.
Okay, you just create a separate T account. It's completely separate. It's completely standalone. Where would you show that though? Disclosure. Where would that go? Income statement. Okay, the income will go to the income statement. The bank would have affected the statement of financial position. All right, and that's how you show bad debts recovered. Does that make sense? Okay, perfect. Right, then, yeah, there's no real practice questions here in the textbook other than the examples. They do give some self-test questions, but this is theory. For example, define what a debtor is, explain what debtors and trade receivables are, fill in the missing words. So these things you can do if you want to practice, but it's just theory that we've already covered. Okay, happy?
Yeah.
All right, so that's another chapter complete. All right, we now need to look at how we're doing with time. Okay, we'll have to carry on next time, yeah?